Right now, millions of senior Americans are sitting on a financial time bomb, and most of them don't even know it's ticking. The IRS has confirmed that April 15th, 2026 is a hard deadline. No extensions, no grace periods, no second chances for the people this directly affects. And if you, or someone you love, is over the age of 65 and receiving Social Security, pension income, or required minimum distributions from a retirement account, what you do in the next few days could either save you thousands of dollars or cost you penalties you absolutely did not budget for. I've been watching this deadline closely, and there is one specific change in the 2026 tax guidance that seniors are completely misunderstanding. Stay with me, because this breakdown could protect your retirement income. My name is Raymond Crivello. I'm a senior financial and policy analyst, and on this channel I break down complex government deadlines, tax policy changes, and federal regulatory updates into clear, fact-based analysis that you can actually understand and act on. This channel is not about rumors, it is not about panic, and it is definitely not about clickbait. Everything I present here is sourced directly from IRS publications, federal guidance documents, and official regulatory filings. Before we go any further, I want to be transparent with you. I am not your accountant, I am not your tax attorney, and this content is strictly for educational and informational purposes only. For your specific tax situation, always consult a licensed CPA or tax professional. Now, let's get into exactly what is happening, who it affects, and what you need to do before April 15th. Here is what is happening and why it matters specifically to seniors this year. The IRS April 15th, 2026 deadline is the standard federal income tax filing deadline. But what makes 2026 different, and what is catching thousands of retirees completely off guard, is the intersection of three separate financial obligations that are all converging at the same moment. First, let's talk about required minimum distributions, what the IRS calls RMDs. If you turned 73 years old in 2025, federal law under the Secure 2.0 Act now requires you to begin taking mandatory withdrawals from your traditional IRA or 401k. These are not optional. The government requires it because those accounts were funded with pre-tax dollars, and the IRS wants its tax revenue. If you did not take your first RMD by December 31st, 2025, or if you deferred it under the one-time first-year exception to April 1st, 2026, you may now be holding two RMDs that are taxable in the same calendar year. That is a situation that can quietly push you into a higher tax bracket, and that is something many seniors and even some financial advisors are underestimating. Second, and this is the part most people are missing, Social Security taxation thresholds have not been adjusted for inflation in decades. This is a structural issue in the tax code. If your combined income, which the IRS defines as your adjusted gross income plus non-taxable interest plus half of your Social Security benefit, exceeds $25,000 for individuals or $32,000 for married couples filing jointly, up to 85% of your Social Security benefit becomes taxable. And with RMDs now added into that income calculation, millions of seniors who previously owed little to nothing in federal taxes are discovering that their 2025 tax liability is significantly higher than they expected. The April 15th deadline is when that bill comes due. Third, and this is where it becomes critical, the IRS penalty structure for underpayment is real, and it is not small. If you are a senior who did not make quarterly estimated tax payments throughout 2025 to cover your increased tax liability, you may face an underpayment penalty on top of the taxes you owe. The IRS generally requires that you pay at least 90% of your current year tax liability or 100% of the prior year liability, whichever is smaller, through either withholding or estimated payments. If you didn't, the IRS charges interest on the underpaid amount, calculated from the date the payment was due. That accumulates quarterly, and it is not forgiven simply because you are on a fixed income. But here's where this becomes critical, and I want you to understand this through a real example, because the numbers alone sometimes don't hit the way a real situation does. Imagine a retired couple. Let's call them Harold and Diane. Harold is 74, Diane is 71. They live in Ohio. Between them, they receive about $38,000 a year in Social Security benefits. Harold also has a traditional IRA that he's been growing since the 1980s, now worth approximately $320,000. When Harold turned 73, his financial advisor reminded him about RMDs. But what nobody clearly explained to Harold and Diane is that his RMD for 2025, calculated at roughly $12,800 based on IRS life expectancy tables, would push their combined income to a level where 85% of their Social Security becomes federally taxable. Suddenly, Harold and Diane are looking at a federal tax bill they didn't plan for, and no quarterly payments were made throughout the year because nobody told them they needed to. April 15th arrives and they owe over $3,200 in taxes plus an underpayment penalty. That is money coming directly out of their fixed retirement income. And here's the painful part. This was entirely preventable with the right information in advance. That is exactly why this conversation matters. And that is exactly why I make these videos. There is one more detail most people are completely missing, and it involves a protection that exists but has a strict deadline attached to it. If Harold and Diane file their return by April 15th and pay what they owe, they can request a first-time penalty abatement through the IRS, a provision that forgives the underpayment penalty for taxpayers who have a clean compliance history for the prior 3 years. This is a legitimate IRS program. It is documented in IRS Policy Statement 5-133 and formalized through IRS Form 843, and it is not widely publicized. But it requires that your return be filed on time. Miss April 15th or fail to file for an extension, and your options narrow significantly. So here is your structured action plan, and I want you to take this seriously. Write this down or screenshot this screen. Step 1. Determine your RMD obligation immediately. If you turned 73 in 2025 or are older, log into your IRA or retirement account and contact your plan administrator today. Confirm the exact RMD amount that was required for 2025 and whether it was taken. If it was not taken, the penalty is 25% of the amount not withdrawn, though it can be reduced to 10% if corrected promptly. The IRS has a correction process through Form 5329, and it must be addressed. Step 2. Calculate your combined income using the IRS worksheet in Publication 915. This is available free on irs.gov. Determine whether your Social Security is partially or fully subject to taxation based on your total income picture, including your RMD. Step 3. Calculate whether you owe an underpayment penalty using IRS Form 2210. This form lets you determine whether a penalty applies and in some cases lets you request a waiver based on reasonable cause or qualification for the first-time abatement. Step 4. File on time or file for an extension by April 15th. Filing Form 4868 gives you an automatic 6-month extension to file your return, but this is critical. It does not extend the time to pay. If you owe taxes, you must estimate and pay that amount by April 15th to avoid additional interest and penalties. An extension to file is not an extension to pay. Step 5. Consult a licensed CPA or tax professional immediately, not a tax preparer at a pop-up office. A licensed, credentialed professional who understands retirement income, RMD planning, and Social Security taxation. The cost of a consultation is almost always less than the penalties and interest you would otherwise pay. Now let me give you the bigger picture, because this is not happening in a vacuum. There are ongoing discussions in Congress about adjusting the Social Security benefit taxation thresholds, those $25,000 and $32,000 income levels I mentioned, which have not been updated since 1984. Several proposals have been introduced to either raise those thresholds or eliminate Social Security taxation altogether for lower and middle income retirees. However, and I want to be direct with you about this, none of those proposals have passed both chambers as of the date of this video. They would require congressional approval and a presidential signature before becoming law. Until that happens, the current rules apply, and April 15th remains your deadline. Do not make financial decisions based on legislation that has not yet passed. Operate based on current law and stay informed as things develop. The realistic timeline for any legislative change to Social Security taxation is measured in months to years, not days. Plan accordingly. I want to take just a moment before we close to be direct with you about what is actually at stake here, because this is not just about a tax bill. For millions of American seniors, retirement income is not a backup plan. It is the plan. Social Security, RMDs from retirement accounts, pension checks. This is how real people pay their rent, their prescriptions, their groceries. A surprise tax bill combined with IRS penalties does not just create financial stress. It creates decisions between medication and food. It creates calls to adult children asking for help. It creates anxiety that affects health outcomes. I take this seriously because the people watching this channel take their financial futures seriously. You deserve accurate information, delivered calmly and clearly, so that you can protect what you have worked your entire life to build. If you want accurate, fast, and reliable financial policy updates, subscribe to Raymond Crivello right now and turn on notifications. Tax policy, retirement regulations, and federal deadlines are changing rapidly, and staying informed is no longer optional. It is essential. If this video helped you understand something that your accountant or financial advisor has not yet explained to you, leave a comment below. Tell me your situation. Are you dealing with RMDs for the first time? Are you concerned about your Social Security taxation? Share this video with a parent, a grandparent, a neighbor, anyone over 65 who has a retirement account. They need to see this before April 15th. And if you believe in factual, calm, responsible financial education, hit that like button. It tells YouTube this information deserves to reach more people. I'm Raymond Crivello. Stay informed, stay protected. I'll see you in the next video.